If you have a self-rental, meaning if you got a business and you rent from yourself another property that you own, you might fall into what I like to call a self-rental trap. Very little accountants out there know that actually IRS has specific rules involving when you rent from yourself. And if you don't follow those rules properly, you could actually be missing out on a lot of potential tax deductions. In this video, I will show you exactly how to structure your self-rental to utilize everything that IRS allows you and to take those losses from the self-rental against your business profits. That's right, it's possible, and in this video, I will show you exactly how. Let's get started. Hey, welcome to my whiteboard tax strategy. My name is Boris Musheyev. I'm a CPA and a certified tax strategist. Every Tuesday, I release a tax strategy video here on YouTube for you, the business owner. By watching this video, my goal is for you to start paying less in taxes right away. So go ahead, subscribe to my channel, like it, share it, and even comment below. I appreciate you. Now let's get started. Awesome, let's get started with this tax strategy. So I've broken it out for you in 3 simple steps as usual. We're gonna talk about what is really self-rental. You must understand what it is so you can take it to your accountant and be like, hey, are we doing this, right? How it really works and a tax strategy. By the end of this video, you will know exactly how to implement this tax strategy. So you already know me by now with all the video that I produce here on YouTube. I hold nothing back, and everything that I give you is so that you can start implementing it right away. So make sure to stick around until the end. So let's talk about how does this work. Generally, what's considered a self-rental is that when you own a business, but you also own a rental property and you pay rent to yourself, right? So business rents from you. You've got a business that is a separate entity. That could be an S-corporation in this case, for example, and it rents from you. It pays monthly rent to rent out your space, okay? The rental income, IRS says, is not considered passive. That means when you rent from yourself, any income, net profit that you generate minus all the expenses, IRS says, nope, this is not a passive income. That is actually a huge blow. The reason it's a huge blow is because if you own other rental properties, let's say you've got real estate properties or anything of that sort, losses generated from those real estate properties are not deducted against the net rental income that you get from yourself. That is actually a really, really huge blow to those that rent for themselves. But is there a tax strategy around it? Absolutely. Stick around, okay? We'll definitely talk about that. IRS goes a step farther and says that, hey, any losses, right, that are generated from this rental property, actually, I'm going to delete this word not, right, are considered passive losses. That means that those losses generated from rental property are not active. That means you can't deduct them. That means they are passive. Another huge blow. So you mean to tell me that the income is not passive. That means I can't deduct my passive losses. And the losses are passive. That means I can deduct it. You follow what's going on over here? I have no idea why in the world does IRS treat it like this, but IRS, as always, as if you already know by now, watching all my videos, I always teach you the tax codes that the IRS gives you to go around its own rules that it creates. So let's kind of talk about this, okay? Now, what's important about a self-rental is that you must know that any losses produced by those self-rental, even though they're considered passive, but they can actually be deducted against your business income only, okay? Let's talk about that. How does that work? So you must know how to deduct those losses against your business income, and that is exactly what we're going to talk about. We're going to talk about how it works, and like I said, you will know by the end of this video how to implement this tax strategy. Stick till the end, and we'll be right back after this break. Hey, Boris Musheyev here. Sorry for the quick interruption. 5 seconds, I promise. I want to make sure you get your free PDF, 7 write-offs every S-corporation business owner must know. The link to this free PDF is in the description below. That's it. Thank you so much. Continue watching. Awesome. Let's get started. So let's talk about how this works, okay? So here's you, the business owner. You have a business, but you also have a rental property. Now, in order for this to work, the rental property can be either under your name, which is totally okay if it's under your name, or in a separate entity, okay? It can be an LLC, if that's what you want, or an LLC owned by your spouse. And the business has to be a pass-through entity. This cannot be a C corporation. So if you have a business on a C corporation, watch some of my other videos and content that I have on my channel, how you can actually save money into not being a C corporation, okay? So definitely take a look at that. But what happens is that your pass-through entity business now pays you monthly rent to your property, and the rent has to be a fair market value. It cannot be rent just to cover expenses. No, if the fair market value rent for this type of space in that area is $5,000 a month, then you pay $5,000 a month. So what happens is that your business now pays the fair market value rent to you or to your property into that separate business bank account. And this entity right here, whatever that may be, even if it's not an entity or a single member LLC, gets to record the rent, gets to take all the expenses to maintain that property, including depreciation, property taxes, mortgage interest, and so forth, okay? So you pay fair market value rent. Now, the strategy over here is that this is a self-rental. You can actually generate losses in it and make certain IRS elections, which we're going to talk about in a tax strategy. So make sure you stay till the end. Make that election, take those losses and deduct it against business income. And to do that, you want to make sure you do accelerated depreciation on that rental property. I've got a video, should be in the link below, somewhere in the description, showing you how to do accelerated depreciation using cost segregation. So the strategy, the biggest strategy that we actually do for all of our tax advisory clients, if they own a property and a business and they rent from themselves, almost always we do an accelerated depreciation. We generate a huge loss and deduct it against business income. Just recently, the most recent tax advisory client that we did this for generated $130,000 in additional depreciation deduction. We're able to take the IRS code that allows us make that election on that tax return and deduct it against her business income. So definitely you want to follow this structure right here. How it works, it's either you, the business owner, own the business and own the property. We're going to talk about the strategy details in just a minute. Pay yourself a monthly rent. Make sure it's fair market value. Separate these two things out, right? The business and the property. And make sure you do an accelerated depreciation cost segregation, because in this case, cost segregation could be huge factor for you. Now, let's kind of move on to a tax strategy and talk about how it works, what you need to do so that you can start implementing this tax strategy right away. We'll be back right after this break. Hey, thank you so much for watching the video. Very quickly, if you don't mind, I want to ask for your help. I need your help. I want other business owners just like you that will benefit from a video like this to catch this video. The best thing that you can do for me, please either like the video or even say something in the comments, because that really helps the YouTube algorithm when it sees a lot of engagement to push the video to other business owners just like yourself. Or better yet, subscribe to the channel would be much appreciated. Thank you again. Now let's get back to the tax strategy. Awesome, welcome back. All right, look, let me just kind of stress something. You are a business owner. Every day you go out and you make money. You generate sales. You make sure your profit margins are high. What happens to 40% of those profit margins? You give it away to Uncle Sam. As a matter of fact, IRS tax code is written in a way where you can save money on taxes. More than 80,000 pages of the IRS tax code, majority of it is written in a way to help you save money on taxes. A strategy like this is in the tax code. Of course, it's not going to be written in a black and white. Hey, use a self-rental tax strategy to save money on taxes. It gives you a tax code, and you need a tax advisor to decipher the tax code. If you're working with a tax preparer that meets with you once a year, doesn't even talk to you about things like that, I can guarantee you right now, you are overpaying in taxes. Now, in this tax strategy, it's important for you to take notes on this. I don't recommend going out and start implementing it right away. This video, I'm teaching you and educating you about a tax strategy that you must be aware of, and you must be working with a tax advisor to get this tax strategy implemented. So, number one is you want to make sure you meet the economic test. That means you have 100% ownership of the business and 100% ownership of the property. Now, what happens if you own either the business or the property or both of them with your spouse. That's okay. If you're filing a joint tax return, IRS says that because you're filing a joint tax return, you and your spouse is considered as one individual for the purposes of the self-rental tax strategy. So it is as if you own 100% either of the business or for property for the self-rental tax strategy to work. Now, what if you own a business with your partner? Let's say you're 50-50 partner over here on a business and you own 100% of the property which rents to you, then unfortunately you cannot use this tax strategy. You've got to make sure you pay fair market value rent, okay? Treat it as a legit business, a legit rental, as if you had a landlord to whom you pay rent. When you do that and you follow all these guidelines and regulations and make it legitimate, have a documentation, IRS will allow you to use 100% of this tax strategy. Now, pay fair market value rent. Also remember that it's got to be separate entities. Now, it doesn't matter if the property is not in a separate LLC, okay? That's okay. It can be under your personal name as well for this strategy to work, but keep them separate. The business, remember, the business has to be a pass-through entity. If it's a C corporation, this tax strategy is not going to work. Now, you want to make sure it's an S corporation or a pass-through entity. Now, you've got a property over here, you're paying a monthly rent. Most important thing that a lot of accountants don't do and don't know about this tax strategy is that they do not make an election on the tax return to combine these two activities. And the election must say, we are combining, or a taxpayer is combining his business as his rental as one activity. When you combine it as one activity, any losses generated by the rental property that you rent to yourself can be deducted against your business profits. If you don't make such an election, you will not be able to take that loss, and you fall into the self-rental trap that we spoke about, because rental income from self-rental is not passive and the rental loss are passive. So it's a huge blow, but that's okay. IRS gives you a way out, because IRS says, look, you're renting to yourself, we're going to consider it as a one entity. But in order for you to be able to take that loss against your business profits, you have to make a proper election. One last thing I want to add over here. What if you own the business 100%, either you or your spouse, but the property is a multi-tenant property, right? It's a commercial property. You've got 3 tenants. One is you and 2 others are other tenants. You can still use this tax strategy for the portion of the property that you occupy as a tenant. It's a really amazing tax strategy that we use for most of our tax advisory clients that have a self-rental. Of course, there is documentation involved, there is tax strategy, there is an election, there's properly filing a tax return, and we do all of that for all of our clients. But we only do it for them. Ladies and gentlemen, you have to understand, we as a tax advisory firm are only able to help our clients to save money on taxes simply because we meet with them at least 4 times a year. We communicate. Communication is the key with your accountant. If you're working with an accountant and you only speak to them during the tax time, filing time, or they're ignoring you, you send them an email and you hear back in 3 days, or you send them an email and they say, oh, sorry, you're going on extension, I have no time. Well, guess what? You need to get a tax advisor so that you can implement tax strategies as a self-rental. Thank you. Till the next time.